Hello and welcome to MF Corner. I'm Sonal Bhutra in the Mumbai studio, and today we are going to talk about investing and SIP investments. Of course, that is the major route that most of us adopt as well. Last month, the stoppage ratio for SIPs came in at 79%. That was higher than what we saw earlier as well. But the gross SIP inflows looked robust. We have been around that 25,000 crore mark. What should investors do during market volatility? Should they switch to other investments? What are the benefits of Stepup SIPs as against regular SIPs? We discuss this and more with our guest today, Raghav Iyengar, CEO at 361 Asset, and Anthony Heredia, MD and CEO, Mahindra Manulife Mutual Fund, joining in now. Gentlemen, good afternoon. Thank you so much for joining in. Usually what happens is when markets fall, there is a lot of fear, and we see SIP stoppage ratio increasing. It was around 50% in the month of June, July, but now it's come in at 79%, very high in the month of November. What explains that? Raghav, let me start with you first up.
Thank you so much, Sonal, for getting me on the show. It's always a pleasure to talk to you and my old friend Anthony on the other side of the coin. I think importantly, one should look at the fact that the gross flows in terms of new flows came down sharply in the month of November. So actually, even though the SIP stoppage looks very high, in terms of actual amount or in terms of actual value, it was hardly up by about 2-3%. We haven't seen this level of reduced inflow since May 24. And if you see the correlation between May and November, May was the election month, obviously some amount of uncertainty around the elections. And obviously that led to some people maybe postponing investing through SIPs. And I think the same thing has happened in November, where you have seen, obviously on the back of an October, which was not a very great month for markets. You saw a very steep correction in that time. And obviously new investors tend to get a bit disoriented and obviously want to get some sense of, comfort before they restart or rethink their investment portfolio. So I think if you ask me, two problems. One is the SIP stoppage number was pretty similar to what it was in October. So, but having said that, the gross inflow in November in terms of new accounts actually fell off quite a bit.
Yes, exactly. So, just to follow up on that, Raghav, before I get in Anthony in the conversation as well. So how should investors read the monthly SIP numbers then reported by AMFI? Should they look at the gross number? Should they look at the stoppage number as well? And that shows the clear picture. How would you look at the consistent improvement we've seen?
I think we've had a blockbuster SIP year. So we've had 20-odd thousand crores of SIP flows in the month of April 24. And in like under 7-8 months, you've seen that number go to 25,000 crores a month. So month here and there, in my opinion, doesn't make too much of a difference. I think as long as the big picture looks fine, which is 25,000 crores, is a very, very healthy number. I mean, not too long ago, if you go back to 2019, the annual flow of the industry used to be 5,000 crores of SIP a month. So when you're looking at 5,000 crores of SIP for the whole year, 5 years back to 5,000 crores of additional SIP money coming in less than 6-7 months in a current year, I think a month here and there, a blip should not worry me at all. It doesn't worry me, frankly.
Okay. All right. Then, Anthony, let me come to you. Your thoughts. Markets have been very volatile. What to do with SIPs? And how can one read the numbers that we have seen so far when it comes to SIP contribution? It was flattish in the month of November.
So I'll take up from where Raghav left. I think the key number from my perspective is the total amount that's coming in, right? The 25,000 crore number has been fairly constant. I think in some sense, there's a period of consolidation before hopefully we see another pickup in numbers. So I think that's the first key stat. The second is one of the things that I've seen in the last year is not just the number of SIPs, but the average ticket size per SIP is definitely gone up at least 15-20%. The stoppage ratio doesn't worry me in one perspective. It worries me from another perspective. The one that it doesn't worry me about is I think it's more a maths problem because it's the gross SIP numbers that have come in lower. I think it's 50 lakhs versus 60 lakhs. That's why the stoppage ratio looks what it is, because that's the way people look to calculate it. What is, I wouldn't say worrying, but an observation. I have definitely between October to November seen a shift in sentiment, which is affecting gross flows, both SIP as well as lump sum. And I think what's happened, as Raghav pointed out, in October, the steep correction, people said this is a great opportunity to buy. There was a lot of money on the sidelines. When the correction, or let's say the consolidation, lasted through November, I think people have, a lot more people have moved into a wait and watch mode. And I see that, frankly, continuing in December as well. So I think to some degree, gross flows have come off. both on lump sum and SIPs. Now, to your question of what should somebody do, the ideal thing, frankly, as time always tells us in hindsight, is you should do nothing. The whole key is to keep investing, invest regularly, stay for the long term. If markets are volatile, if at all, it should provoke you to probably put a little more money to work. But I think just staying put to your current investment journeys is a great first step. That's the one thing I would say should be done during volatility. But as they say, the cliche, easier said than done.
That's exactly what we saw in November as well, right? The market volatility did scare few. Raghav, same question to you. I know the idea is the same. Stay put because markets have been volatile. Do you think that was the right time for investors to maybe put in a little more money or just stay put, do what you have been doing and be disciplined there?
I think I would go with stay put, be disciplined. I think that's the two most important words. Very, as Anthony said, very difficult, very easy to say, very difficult to do. But thanks to shows like yours, hopefully people will continue their journey and not do anything unremarkable. I think it's wait and watch is not a bad idea, especially for a first-time investor. See, understand also, Sonal, that this year we've had possibly the highest incremental new investor flow in the industry. These are people who have seen sort of a one-way movement from April to September. I don't think we've had any meaningful monthly correction, and that's happened in October. And thanks to we all know that these things, equity second name is volatility, right? So for people like us who've been in the system for some time, that's normal. But for new investors, obviously, it's a bit frightening. So I guess just stick the course, I think is my advice to people. If you have some risk appetite and your financial plan allows you to do it, maybe like they say in the good old days, buy the dip. Keep adding to equity allocation if you have some extra money and you can put it away for some point of time, and obviously you have a risk appetite for it. But otherwise, just stay the course. I think that's very, very critical right now. Don't do something abrupt just because something is happening on the index, which is frankly, and which is frightening you. And then more importantly, keep watching shows like yours to get that comfort.
No, that's why we get experts like you and Anthony on the show as well, right? It is never a bad idea to reiterate the basics because basics are what make up for majority of your life, majority of your investment theory and investments as well. So we take that point definitely. So let's try and make it easier with an example. Let's do that, Raghav. What would a 10,000 monthly SIP do after 10 years if it started today? I keep asking this because it just shows the power of compounding. And when it comes and is reiterated again and again, it at least gives some comfort to investors who are scared in volatile environments.
I think that number becomes quite astounding, frankly, that 10,000 rupees over over 10 years gives you roughly about 12 lakhs of investment gross value. That if you compound it at say 12%, it roughly almost doubles. Expected of almost 23 odd lakh rupees is what you will get. So, when you start with a 10,000 rupee ticket, you don't anticipate making 23 lakhs at the end of 10 years. I mean, then that's the power of compounding that you see. It's pretty pure, simple mathematics, but as human beings, we are very good at addition. We are very poor at multiplication. Compounding is a multiplication factor. So I think it's something that you have to actually sit down and just, if you do the math, you'll understand it very, very clearly. Just take a piece of paper and a pen, and it'll come very naturally to you. So that's the kind of money that you can make at 12%. Now, will the markets give 12? Will they give 9? Will they give 10? But all of us know that, Sonal, that equities are a great compounding asset. They are a great inflation-beating asset. The trick here is to stay invested for a long period of time and be disciplined and continue to do what you're doing. If you ever pause this journey or step off that journey, I think that whole number can dramatically change.
It can, and the table just shows that one table can answer a lot of confusion, a lot of queries as well. So just stay put, continue with your SIPs and do it in a disciplined manner. We have a lot more questions on SIPs. How does it compare with lump sum? What are Stepup SIPs? But we have to get into a quick commercial break. We'll do that. And on the other side, we'll continue our discussion with Raghav Iyengar of 361 Asset and Anthony Heredia of Mahindra Manulife MF on investing via SIPs in the new calendar year. Stay tuned. Welcome back. You're still tuned into MF Corner. We have with us Raghav Iyengar of 361 Asset Management and Anthony Heredia of Mahindra Manulife MF on investing via SIPs and how you should look at the new calendar year as well. Anthony, let me start with you this time because we've spoken about SIPs in general when we do it in mutual funds. But what is your take on stock SIPs in this case? Would this be a more prudent step for investors?
So I'm going to give you probably a controversial answer and say I don't believe in stock SIPs because as a portfolio manager, to me, when you buy a stock, you buy it after a lot of research, you do buy it after a lot of work, and then you have conviction that this stock is going to do well over a point in time. So after having done all of that work, I see no reason to risk price movement in a stock. See, the point is we talk about SIPs delivering 12% return CAGR over time, which is therefore, markets move 1-2%. Stocks may not move 1-2%, right? So if I've done all the hard work and I believe that the stock is something that I'd like to own for the long term, I would go all in. I mean, let me give you a simple example. Think about a stock today that is up 5 times or 4 times in the last 10 years. Do you actually recollect, if you had done it via stock SIP, the purchase price almost becomes something you forget 5 or 10 years later, right? So I think buying a stock is more about doing the hard work, figuring out what the margin of safety is. And if you believe that buying it at this price is the right thing to do, you go all in, is my view. Personally, I have never bought stocks. I mean, honestly, given the industry we work in, you should eat what you cook. So we probably buy funds more than we buy stocks. But I have never used the SIP route on a stock that I've bought personally, because to me, if I have deep conviction that this business is going to do really well over time, I really don't want to average it out and be caught out by the fact that the market discovers it pretty much at the same time. So I'm not a big votary of stock SIPs, frankly.
Okay, and Raghav, would you agree with what Anthony's saying? Do you have a different view on that?
No. I think he's way my senior in the industry, so I better agree with him. Number one, not for anything else, but I completely agree with what he does because it's not very easy to buy a stock. I think there's a fair amount of hard work that goes into buying a stock. I think SIP as a brand has become so popular that everyone uses it for everything. So I think there's nothing like a stock SIP. It's just that you buy a set of stocks regularly every month, which frankly, in my sense, defeats some purpose because more importantly, buying is the easy part, selling is the difficult part. So when you keep buying a set of stocks consistently, you don't know what, those stocks underlying fundamentals could change very, very dramatically in the period that you're buying it. So if you ask me, Sonal, SIP is a great disciplined way to do it. You can do an SIP in anything actually. But obviously the easiest thing to do is to buy a mutual fund. It's a curated list of stocks. There is a fund manager. There are a set of research processes. It's a very, very beautifully regulated industry, extremely transparent. And then more importantly, I think it's up to the fund manager then to do the due diligence and the stock research to give you the best of what he or she thinks can deliver to you, right? And more importantly, if something doesn't work in your favor, you can always press a button and take it out. And lastly, I think it's extremely well and tightly regulated. It's very transparent. So I echo Anthony over there that I have never done a stock SIP. It's a very nice thing to do. It's a great feature that many people have added, but I think it's easier to do that through an MF route.
But the click of that button, that is making everything so easy that you do it with every asset class that you get nowadays. But just to follow up on that, Raghav, do you think a combination would work, or should a combination should not also be taken up by an investor? That SIPs in mutual funds plus SIPs in stocks, if you are sure or confident about that.
Different strokes for different strokes, Sonal. So I have no idea. I'm an SIP kid, so I've grown up eating SIPs all my life. I can't change my diet at the stage where I'm in life right now. And then more importantly, I think the governance around buying stocks, especially if you work in a mutual fund, is very, very. It's not the easiest thing to do. So I'm very happy to stick to my dal chawal, which is my SIPs. I think, of course, but there are a set of people who have much more intelligence than I have. They research stocks, they know what to buy. More importantly, they know when to sell. Maybe for them, a stock SIP might work, but definitely not for me.
people are adding a lot of spices to that dal chawal
Yes,
combination
of course.
nowadays. So maybe that's what's making the meal fuller and different. But do take your point, both of you not exactly in favor of stock SIPs, going by your answers as well. Anthony, then let's take the SIP route in the mutual fund industry a bit forward. Does a step-up SIP make sense in a scenario like this? When should an investor go for step-up SIPs? Can you explain that? How does it work for an individual investor?
Yeah, thanks for that. But I'll first respond to Raghav. Raghav said that at this age, and then he said, I'm much more senior than him. So, I think it's almost time to retire. But on a more serious note, so I think it's, the fundamentals of why are you doing a SIP? It's probably to meet aspirations which are in the long term. And I think there's a massive social change that's happening in India, right? I mean, aspirations, especially of the younger generation, is changing all the time. At the same time, hopefully, most people have income levels that also rise. So if you've done the great work of starting a SIP of, let's say, an aggregate of 20% of your savings or 20% of your monthly income today, and you kind of happy with that, you realize that over the next 5 or 6 years, honestly, your aspirations are going to change. And if you don't change the SIP amount to make sure that your aspirations and your income levels are kind of aligned, I think you're kind of selling yourself short, is my view. And to that extent, a step-up SIP that is nicely correlated. So it doesn't have to be automated, right? I mean, you don't start a 10,000 rupee SIP and then automatically change it to 12,000 or 15,000. I think just another way of looking at it is you've done a 10,000 rupee SIP, and obviously 2 years later, the 10,000 rupee SIP is no longer 20% of your income. It's probably only 10% of your income. And so it makes sense to make it 15,000. The point that Raghav earlier mentioned, compounding, right? I mean, that comes through in a step-up SIP in a massive manner. So if you're talking about arguably doubling a SIP done over 10 years, over a 4 or 5 year time frame, with a step-up SIP, you're probably looking at that number going to 3x. I mean, that's the power of a step-up SIP, assuming that equity continues to deliver in the long term, which if you look at past data, there's no reason to believe it won't. So I would be a very strong advocate of step-up SIP is the technical word. I'm a strong advocate of making sure that your savings are always aligned to your levels of income, which hopefully for all of us in a rising India continues to move up.
Yeah, that's something everyone hopes, right? We're talking about savings, but income also has to go up, considering the other macro factors as well. Raghav, your take on step-up SIPs, and just a word on lump sum versus SIPs, because that is also something that confuses investors a lot of times.
No, so step-up SIP is it's a feature, Sonal, for lazy investors like me, right? Who don't do the hard work like Anthony does. We don't check our income every year. We assume that we're getting some money and we very happily, lazily put away and saying, "Aap kya kar rahe ho? I'm putting money in SIPs," but you don't correlate that SIP to the total income that you have. So if you have maybe if you put a 10% step up every year, the results are quite amazing actually, because you can, your 10% step up every year. If you do it for a 10-year period, your corpus can be almost 3x of what you started, assuming markets are at about 11-12%, right? And these are obviously just for examples, right? I mean, the whole idea is that over the last couple of decades, India has done really well, and hopefully we'll continue to do well. So equity as an asset class is great. So it's a feature, it's an auto feature. Now, one way to do it is to do it through the feature. The other way is that, hey, every year look at how much money you're making. Are you saving that 20-25%? If you're not, please do that, because it's very easy to consume also in India. I think it's a very beautiful consumption economy, and I think time is one thing that doesn't come back to you. No, money will come back, but time won't come. So if you can do it, if you are that lazy guy like me, then please do a step up, because it automatically increases your value without you realizing it. If you're someone disciplined, then yes, please look at your numbers every year and then take necessary action wherever it is. Coming to the second point, I think lump sum is again, depends on what kind of money you're getting. If you've got a pile of money, and you have a reasonably clear goal as to what to do with it, instead of doing a SIP or a systematic transfer plan, which is what a lot of people advocate, I think it's okay to put lump sum money, provided you're clear that you need money over a fairly long period of time, and you're okay to take a few knocks along the way, which is what equity markets will do. There will be months where it doesn't always work in your favor. So I think,
Okay,
obviously, I think the faster you deploy that money, it benefits from compounding immediately.
got it.
And I've also seen that sometimes if you just postpone investments, it stays postponed for a very, very long period of time. I know some very close friends of mine who are yet waiting for index levels of 15,000 to re-enter. I don't know whether that will happen, when it will happen, but I think the cost of waiting is much, much higher than the cost of
Yeah.
investment.
Take that point, and it was such an insightful chat, and liked your banter as well. Make the show more lively. So hope to be getting both of you soon again on the show. A different topic that would bring more awareness to the investors and educate them as well. Thank you so much for joining in, Raghav and Anthony. It was a pleasure speaking to the two of you today.
Thank you, Sonal. Thank you, Anthony.
Take care.
Okay.
Thank you.
All right. That's all we have on the show today. Stay tuned for Closing Bell to take you through the last hour of trade.